Okay, so we now have our final session of the conference, and I'm joined by Melissa Ball of Energy Impact Partners and Malika Anand of Catalyst Fund. And the conversation is going to turn from entrepreneurship and climate technologies to financing climate tech in our last session today. And I'm going to ask Melissa to kick us off, because we've been talking a lot about what's sometimes called deep tech or hard tech. And this is especially challenging to finance because you have to get comfortable with the engineering or science risk associated with it. So Melissa, if you could start us off, tell us a little bit about, first of all, the work you do at Energy Impact Partners, and then how do you get comfortable with these complex, challenging technologies?
Sure. Happy to be here, and thank you all for having me. So I'm Melissa. I am the Associate Director of Energy Impact Partners. We're a $4 billion under management venture capital firm that only invests in the energy transition and decarbonization. We have 5 strategies, and the most relevant for this conversation is our Deep Decarbonization Frontier Fund. And this fund in particular is the fund at EIP that takes on science and engineering risk. And so we're the deep tech in early stage, so almost nothing in principle is too early for us, which is nice. My background is technical. I'm actually an alumni of Columbia, but not CBS. I was in chemistry, so I did my PhD in chemistry here, graduated in 2019, postdoc at Princeton for a bit before joining EIP 18 months ago. And so basically our mandate is to invest in early stage. So we know there's always going to be science risk. And so we're that fund that wants to deploy capital to really help those entrepreneurs de-risk the science risk and engineering risk, which I'll have separate, and before they go on to the, I think, even a harder stage, which is the commercialization risk. And so what we've done internally is that on the investment team, we have 2 PhDs, which it's probably obvious now that I'm one of those. So we have orthogonal backgrounds, myself and my boss, who is a PhD in mechanical engineering and then chemistry. And we really do a robust diligence process. So we are very metric-driven, very investment thesis-driven. So you name a technology, and in my brain, I will probably know the 3 or 4 key metrics that I know it's going to drive your economics. And so we do an approach called techno-economics. Not almost every single technology, whether we do make the investment or get very close to the investment, we will be building out a techno-economic model, which essentially is looking at your technical inputs and sensitivities and limits and how they're going to affect your bottom line or your production cost. And really what we're looking for is, we know you're not economic today because, again, you're going to be early in our fund, but what's your pathway to go down the cost curve? And so we get comfortable once we think that the science is revolutionary, and the way we like to put it is that, instead of being a vitamin, it's an aspirin. So we really in venture want it to be something that's like solving a big pain point in the market. And then if we believe that the right people are trying to solve or on the team, so if you're doing something in, I will say, let's say a commodity chemical, I'll just say ammonia, and you have, and I love electrical engineers, but if your whole team's electrical engineers, I'm probably going to want a chemist on your team. And so we really look at everything from the team dynamic. We look at your cost model. We'll build out our own sensitivities. We make sure no fundamental laws of thermodynamics are broken. Sometimes they are. And so we're really going super deep with our companies.
Thank you. Thank you for that introduction, Melissa. Malika, tell us just a little bit about Catalyst Fund. The question I want to ask you is, Catalyst Fund invests in climate resilience in Africa, among other places, or it's sometimes referred to as adaptation. That's both a very challenging geography to invest and a very challenging part of the sector to invest. Adaptation is, very few investors have really even attempted to invest adaptation. So how do you think about this at Catalyst Fund?
Sure. So very happy to be here. Thanks very much for the invite. We're Catalyst Fund. We're an early stage VC fund and accelerator backing tech-enabled startups offering resilience and adaptation solutions exclusively in Africa. We used to invest in India and Mexico, but this fund is exclusively in Africa. And I think you're absolutely right that there's not nearly enough attention and not nearly enough dollars going to resilience and adaptation. Even throughout the day, we've been talking about tech, but at every step of the conversation, we've been saying, well, there needs to be a policy intervention, or, how's the system going to work, or how are we going to make sure customers want to adopt these solutions, or feel comfortable, or be willing to take on autonomous cars, or get the $100 in carbon tax we need. Well, so all of those bridges into sort of social and policy bring us directly into the resilience and adaptation space. So I think treating mitigation and emissions as separate from resilience and adaptation and the policy and the social piece is potentially quite short-sighted. That's one. And then I think if we think back to the sort of the McKinsey beautiful piece of map art we saw this morning, there are these beautiful arrows coming from emerging markets into our industrial sectors, but I think what that masked was actually what's happening at the population level globally, right? So 70% of people in sub-Saharan Africa today are under 30 years old. What that means is that Africa looks, well, I mean, probably even younger than this group. And developed markets are going to look more and more like Congress, or so. And what that means is that there's just enormous numbers of people who are facing already the threats and impacts of climate change that need to prepare and manage for future impacts, and also need to think about leapfrogging all of the mistakes that we in the developed world made in achieving economic development and quality of life, et cetera. All of that is the realm of resilience and adaptation. So while I hear you that it's a difficult space and a challenging markets, we're investing in this space and in these markets because we're sort of really optimistic about the opportunity. That this is where young people are, this is where talent is. I think 5 out of the top 10 countries with renewable energy potential are in Africa. People talk a lot about carbon sinks. The second biggest carbon sink in the world is in Africa. So we're there because of optimism and opportunity.
Terrific. Thanks for the intro. Let me just stick on this for a moment. As one of the early leaders in adaptation in EM, what are some lessons you've learned so far? What can you share in terms of lessons learned in this process that others perhaps should pick up on?
Yeah, so I think that it can be tempting to draw really directly from the climate tech world and say, like, there are these pieces of technology that are scientific and you can sort of map and measure tons of carbon, and they're going to work the same in Sydney, Australia, as they might in San Francisco, as they might in Finland. But obviously that's not the case for resilience and adaptation. I think the first lesson for resilience and adaptation is about context and the need for being firmly rooted in context, but in a pragmatic way, right? So you're talking about context in emerging markets that are infrastructure poor, that are data poor, that are potentially tech poor. So you need to be rigorous and context-based without depending on your normal arsenal of census data or meteorological data or any of those sort of, the Dutch, I think, they can document floods for the past 300 years with an alarming degree of precision or a great degree of precision. But that's not going to be true in a lot of coastal countries in Africa. So need to think about solutions that are both incredibly context-specific, but being sort of pragmatic and realistic about the kinds of data that you might encounter. That's one. And I think the second thing is just the need for patient, soft capital in these markets. And this is, I think, potentially as true it is about sort of mitigation technologies as it is for resilience and adaptation technologies. I think a lot of our venture vehicles have like a 10 plus 2 kind of time horizon, but these investments need more like a 10 to 50-year horizon. And I don't think we're really there yet on the financing side in terms of building the right kinds of capital structures for getting these solutions over the line, because they will get there.
Back in 2015, we solved climate change. Now every year we get together to see how.
Melissa, back to you. You mentioned that EIP nothing's too early to invest in. But when it comes to early investing, one of the big challenges is valuation. How do you, as an investor, value a company that's just out of the gate? Share some insights on that, lessons on valuing early stage climate tech.
No, sure. It's definitely tricky. I think the assumption is that when something is rolling out of a lab, and I should say, like, if in this world we invest in seed to, well, my fund seed to Series A, B, our sweet spot Series A. And all that's to say is like you have a technology, you've got a proof of concept, you're pre-revenue in our case most of the time, which makes the valuation tricky. And so there's this conception that perhaps we like the founder, it's like very founder driven, and it's just like we write the check and we're like, good luck. We are not that way. So on our investment team, you have counterparts to me. So I'm doing the techno-economics, but they're building a financial model. And what we're really looking at is like, if you really are that aspirate in the market, what market share does and most of our companies actually come to us with models as well. It's not, we will build our own, they come and we kind of merge the thinking. So they might think they're gonna take over like 100% of the addressable market and we're like, it's probably 10% or 1% in our upside case. And so what we really do is just honestly talk to lots of experts. Our LP base, so limited partners, so we're the stewards of their capital, are some of the biggest utilities, gas, corporates of the world, and we often talk to them and get their impressions of this technology and what's the ceiling for it. And we do really, as I'm sure at CBS they're doing, we're building up a bottom-up analysis to see what we think this company can achieve, and then we're valuing it, doing NPV, DCF, or doing the traditional valuation techniques.
A very objective, analytical way of thinking about valuation.
With large error bars.
With large error bars. Of course, a lot of sometimes valuation negotiation in the sector is affected by hype. Right? Certain technologies are kind of overhyped and others perhaps are underhyped.
Yep.
Based on where we are today in April 2024, well, what in your view is overhyped at the moment, and what perhaps is underhyped or less recognized for investment potential?
Great question. Let me just say, not an endorsement or my own opinion. All technologies I'm very excited for. So just want to be super clear on this. So underhyped. I would say the number one thing, and I think, Malika, you were just talking about this, would be copper. In the last year and a half or so, we've been seeing startups, not the majors and the OEMs, but like startups working on copper. And people might think, why on earth are we doing this? But there is a supply-demand problem with copper, and there's two big driving forces on the demand side, and that is what Malika was talking about. We not only have an underserved population that really wants that like kilowatts per person to match the developed market, but also you have electrification. So this idea behind electrifying everything means you need wires, and if you need wires, you need a lot of copper, because we don't have great alternatives. And so there are alternatives, like you can use aluminum, but for many geeky technical reasons, I won't go into why we're going to want to use copper. And so copper is one that I think the market is waking up to and realizing that if we really want to electrify everything and we want to increase the developing world and population growth kilowatts per person, we need a lot more of it. And how we're going to do that are new technologies, because there is a problem in some of the mineralogy that happy to discuss, and I know Colombia has a big footprint in this anyway, and people here probably know more about this than I do. So that would be my underhyped, looking forward to seeing this market grow. Overhyped, so I'm gonna say overhyped in that this is a harder one for me, because I think it's still from a research perspective is we should be doing it. I'm a fundamental scientist in my heart, so this is not my view on what we should be doing in the labs. I would say in solar, there's a next-gen solar technology called perovskites. So I can say disclaimer, as a postdoc, I worked on perovskites for 3 years. I really like the idea. One of the things I struggle with is we saw this story play out in silicon. So China dominates the silicon market. Silicon solar works incredibly well. It lasts 30 years, and we know the efficiencies. The promise of perovskites is to get this boost in efficiency. It's got lots of struggles. We see lots of startups working on this problem. So I'm excited to see what they do. My worry is that when you think of the levelized cost of energy for solar, the module is really just a small portion. It's like a third of the cost. And so if we really want to drive down cost in renewable energy, we need to do a bit more, I think, than just iterating on the module.
Emerging markets, an awful lot of climate investment is around agriculture. Mm-hmm. Is ag tech, climate tech, is that overhyped? Are there other sectors you think are overhyped? Or where do you see underhyped opportunities in EM?
Yeah, so I think a lot of investors around climate and emerging markets sort of feel comfortable in the ag space. They sort of look at economies, and 70 to 80% of people live in rural areas, and their livelihoods are somehow connected to agriculture. In most of these markets, 30 to 40% of GDP is connected to agriculture. And the focus tends to be on-farm productivity improvements, right? And you might feel the same, right? So we hear a lot about drought-resistant seed, about agrochemicals, about certain kinds of irrigation technologies, and all of these sort of technical fixes to make sure that more stuff comes out of the ground. But in emerging markets and also in developed markets, upwards of 30% of food is lost before it even gets to market, right? So between farm gate and your retail store. And there's almost no attention paid to like why that is or what's happening to all of that food. And for me, that space is really interesting. I think not only is there, there's a huge opportunity to improve to grow the amount of food that's available to consumers by reducing that loss, but there's also the sort of income benefits that reach in our markets, often very vulnerable smallholder farmers. And third, there's an enormous potential to think about the emissions benefits, right? The amount of emissions that are created by just all of this valuable food that's rotting or ending up in landfills. So that is while I understand the hype around ag, I think we're paying there's maybe enough energy around drought-resistant seed. So I'm really interested in sort of food logistics and cold chain. I'm also really interested in the notion of Africa becoming a supplier of carbon credits and emerging markets becoming a supplier in those flows, which I think is one of the nice opportunities that's both a resilience and adaptation opportunity, but also a mitigation opportunity, which for us, are really bullish on those kinds of pieces.
I want to come back to carbon credits in just a sec. So a lot of focus on ag, but your point is it's warranted. There's a lot of need and opportunity there. Is there anything that people are not focusing on in EM and climate tech that, in other words, sort of underhyped that you think there should be more attention to?
Yeah, I think anything having to do with urban life. I think the statistic is sort of 13 of the megacities are going to be in Africa by the middle of the century. And these are cities that are already bursting at the seams. We hear, people who can afford it get around Lagos in helicopters because it's just not even possible to sort of move around on the streets. So anything having to do with urban life, particularly because urban centers are going to be where all of these young people are already arriving. 20 million young people are coming of working age are coming online every year in Africa. So anything having to do with housing, with transport, with cooling, with air quality, respiratory health, anything having to do with urban life really, I think, super underexploited.
Very insightful, thank you. In our remaining 5 minutes, I want to touch on politics, was raised earlier in the conference, and come back to carbon markets, which are associated with policy as well. Melissa, back to you. The question was asked earlier of Mary Barra, what happens if there's political change here in the country? But that's for a very established company, an established industry, EVs. For early stage, deep tech, climate tech, how important is the Inflation Reduction Act, policies are in place, is political change, is that something that you concern you a great deal?
No, so on high level, we don't really know how if there is a change this year, how it's going to affect us. What I would say we're seeing in the market or talking to the startups is that there's definitely concern. So maybe if someone was thinking of fundraising next year or at the end of the year, they might be pulling it a little forward. So we're seeing some I guess, concern, but I would say not to the level of where there's like a freak out in the startup community. And I think a lot of that is because you still have a lot of investors with a lot of dry powder that are investing. And so I think that's really encouraging. We also have, I think it's really hard to take tax credits away. And for the IRA in particular, it was supported by both sides of the aisle. So I think I'm a little bit less concerned about something being withdrawn as opposed to we're getting more clarity on some of the rules. Like, for instance, the hydrogen production tax credit. There was last year in the market, everyone told me that they were going to get green hydrogen and it was going to be $1.50 a kilo. And now there's some pretty stringent, there's still final rulings coming out, but the initial ruling came out and it's pretty stringent and it's in the right direction. I'm happy with what they're doing, but it makes it really difficult if you're going to be a modular ammonia producer in Iowa who thinks they're going to write a PPA and get their wind or solar from Texas. You can't do it anymore. And so potentially. So I think the IRA has been incredibly impactful. I think there's actually quantitative data to show how much it's been impactful in this world. The other part is there's certain trends we're seeing because of policy support. So that would be in the last year, a good example would be something like critical minerals. So last year, rare earths was one that I saw from the Department of Defense and the Department of Energy really come in, and you would see and they have lots of dollars to spend, and they sometimes are the first customer, which is really important for these startups. And so we saw startups actually in that space as well. Right now, we're seeing graphite. So in the last, they always seem to come in bunches, but I would say in 2024, I've talked to, I don't know how many graphite companies, and this is something that Mary was also talking about, this onshoring. So onshoring's been a really, really big theme in the last year and a half, at least since I've been doing climate. And I think it's something that I don't think will go away, and it's really spurring innovation in these critical fields. And when I heard her talk about it earlier, it was actually very encouraging because it's something that we definitely think about when we're investing as well.
Last question on this topic around carbon credits, but specifically tied to policy. So how is policy uncertainty or the lack of policy and regulations in carbon credit markets, how's that affecting those markets, and what does that mean for investing in EM and the work you guys are doing at Catalyst Fund?
Yeah, so I think we saw with some of the entrepreneurial presentations that the way the carbon markets are structured, that there's this they're very much geared towards a developed markets carbon capture sort of model, and not carbon avoidance kind of models. And again, I come back to the sort of population shifts and where we're seeing strong GDP growth and where we expect to see people consuming a lot of electricity. We need to start thinking about how to adapt carbon market infrastructure and the way we price and assess carbon markets to take account of much more avoidance credits and data poor environments where things like additionality are very, very challenging to estimate. And with that kind of a much more vigorous and rigorous thinking around that, I think we'll avoid some of the policy risks that we're experiencing now, which have to do, in some cases, with governments outright appropriating private sector carbon credits, with innovators and private sector providers in emerging markets being unable to access international carbon markets. Forget compliance markets; those are out of the question. But I think the estimate we have in Africa right now is that it takes a $3 to $5 million ticket to even enter the voluntary carbon markets. And here we're seeing Series A is in the $50 million range. Series A in emerging markets is potentially in the $10 to $15 million range. So spending $5 million just to get a piece of paper to allow you to sell, this just isn't feasible. And if we're going to get to that, those downward sloping curves that we've been seeing all day, we have to think about the supply of carbon credits for emerging markets. We're going to run out of forests in Scandinavia. So, but the way the market is structured right now is just not appropriate.
Not fit for purpose. Please join me in thanking Malika Anand and Melissa Ball